guest is based in the UK but refuses to invest in European equities. He's Ian Williams, Chief Executive of Charteris Treasury Portfolio Managers. Instead, he's putting his money in Canadian gold names and banking on increased dividends from the sector. Ian joins us now from London. Thank you very much for joining us this morning.
Okay, thank you. No.
Ian, great to have you with us. Right now, we're seeing very clearly that a lot of investors simply flooding into bullion right now as their safe haven. You've decided to go into the stocks. Why stocks instead of bullion?
Well, for a start, we run a specific gold fund that can only invest in either gold bullion or gold mining companies. At the moment, we actually prefer to be in the mining companies because we think they offer better value. They're very good value, both in terms relative to other equity asset classes, and also relative to bullion itself. So we think gold mining shares themselves are very, very cheap at the moment.
Okay, and what about the dividend side of things? Because for the first time in a long time, we are in fact seeing the gold producers raising their dividends. Is that playing into your thinking when you're looking at the stocks that make it into the portfolio?
Yeah, I mean, if you look, the average gold mining company has cash costs of around $500, $600 an ounce, and they're selling gold unhedged in the market for $1,700, $1,800 an ounce. And they've been doing this now for quite a while. So they're spitting off so much free cash flow. They're more profitable than virtually any other sector of the equity market. And they now have the problem of what to do with all this cash they're spitting off. Now, some companies are more pro-dividends than others. Some companies in the gold mining sector don't actually like paying dividends because they regard themselves as a cyclical industry and dividends are unsuitable. But other companies are starting to disagree, and we're going to see a lot more increase in dividends, and also companies that have never paid a dividend before coming in with quite sizable amounts of dividend payment.
Let's talk about some of the names that are in the portfolio then and address the question of dividends as we go along. In terms of your major holdings, specifically with Canada, who ranks at the top? Which company do you like the best in terms of for your own portfolio?
Okay, we've got Eldorado Gold is one of our biggest holdings. We've got Semafo is one of our biggest holdings. We've got Goldcore. We've just started adding to Agnico Eagle after the recent setback. And we've got some of the more medium-sized ones as well. I mean, we've got 50-60% of this fund is in Canadian gold mining companies. So we've got a good 20 gold mining stocks from Canada in the portfolio.
Now, which of those that don't pay a dividend now do you expect to see a dividend from in the coming quarters?
I think you've possibly got to look at companies like Kirkland Lake and one or two stocks like that where I think it would be the management's intention to maybe look at paying dividend, going down the dividend route rather than necessarily going down the share buyback route or the acquisition route or the further exploration route, which is the three other sources that they could do with their money.
No, I don't think you mentioned Barrick Gold. I'm curious what you think of this one, and also with regards to its dividend, not exactly the biggest yield in history, but I don't think you said that name with regards to the portfolio.
No, we do own it, but it's not one of our bigger holdings. I mean, it's we've tended to try and go, apart from Goldcore, we've got a big holding in Goldcore, but apart from Goldcore, we've tended to not go for the ultra big 3 or 4 names and go for the sort of ones just below that, if you like, because we felt they just offered superior growth prospects.
And with regards to Goldcorp, again, another company that as big as it is, and it throws off a lot of cash, not a big dividend there. Among the stocks in your portfolio, which ones are the dividend payers that are paying a dividend now, you like the dividend, but expect to see more from in the future?
Well, Goldcorp would be a classic example of that. And possibly Agnico Eagle as well.
And Agnico Eagle, again, you mentioned their troubles in recent days, recent quarters. You've been adding to your position. What are your thoughts in terms of that company's management? Are they doing the right things? Do they have the right people in place to improve on the most recent quarters?
Yeah, I mean, our view on that is that the bad news that came out resulted in an extremely hefty downsizing of the share price, and we think that possibly the market has overreacted and that things aren't quite as bad as the current market price suggests. And at this level, we would regard Agnico Eagle as more of a buy than a sell.
And Ian, I know you also run another fund that invests only in FTSE 100 stocks in the UK. I'm wondering, from where you sit in the UK, your thoughts on how things are unfolding in Europe.
Well, I think Europe's a basket case and will remain a basket case for possibly the next 10 years, especially the southern Mediterranean countries. What you're seeing on a global macro scale within Europe is that where this the fallout from the 2008 recession, when it hit America and Britain and other countries that have their own independent monetary policy, they've all responded by printing money and effectively trying to print their way out of trouble. The problem with the euro is that that can't really happen under the present system, and that Germany is actually imposing, trying to deflate their way out of this rather than inflate their way out of this. And this is going to cause enormous problems for the Spains, the Greece, Italys, and possibly even France as well, because these economies just aren't going to deliver enough. The debt is compounding up faster than the economies of these countries can grow.
And Ian, if you say, as you say, Europe is going to remain a basket case for as long as 10 years, what's that going to do to UK stocks? What's it going to do to your fund?
Well, when I say, when we talk about Europe, I'm talking about the Eurozone, countries that are in the Euro. Britain's not in the Euro, and the FTSE 100 index is very much a globalized index. So 70% odd of the constituents of the FTSE 100 are really international trading stocks. I mean, a lot of the big mining stocks that are in the FTSE are really Australian companies or Russian companies have very little to do and do very little business in the UK, but they are big enough and they want the prestige of having a London listing and being in the London top 100 shares. So there's more a proportion of overseas activity companies in the UK FTSE than there is UK domestic stocks. So, and the fund is geared towards the overseas earners within the FTSE. We have very little in the fund that's dependent on the UK economy.
All right, very good point. Ian, thank you very much for joining us this morning. We appreciate it. Ian Williams, Chief Executive of Charteris Treasury Portfolio Managers, joining us from London.